Welcome to today's webinar, sponsored by Deep Futures Analytics and OnApproach. My name is Pete Kears. I'm Senior Engagement Manager for OnApproach, and I'll be moderator for today's session. Our topic today is Deep Futures Analytics CECL Study, Alternatives, Impacts, Accuracy, and Complexity. This study was funded by OnApproach, NAFCU, Allied Solutions, and others to explore the best modeling approaches for CECL. Deep Futures Analytics is an analytics CUSO that provides modeling, data pooling, and CECL analysis for credit unions. Our presenter today is Dr. Joseph Breeden, COO and Chief Scientist of Deep Futures Analytics, LLC. Dr. Breeden is also founder of Prescient Models, LLC. Dr. Breeden brings more than 20 years of experience from leading financial institutions through financial modeling, allowing clients to achieve real understanding of portfolio dynamics for retail lending where those problems originated. There will be a question and answer at the end of the presentation. Please feel free to ask questions via the chat or the questions function. At this point, Dr. Breeden, I'll turn it over to you.
Thank you. Hello, everyone. Good afternoon, depending on your time zone. We are going to go through today a study that was just mentioned. This study was sponsored by NAFCU, National Association of Federally Insured Credit Unions, OnApproach, and Allied Solutions. We appreciate their support for this. At the same time, I need to say that the conclusions in here are my own. I don't want to accuse any of them based on the statements I might make in regards to CECL or its implementation. The goals of this study, first of all, just to test the alternative approaches that are available under CECL. The CECL, Current Expected Credit Loss, the guidelines came out last summer, and they were artfully vague. They said you could do many different things depending on the size of your institution or the size of the portfolio. But what does that mean? What should we do, and what can happen based on our choices? That's the key question. So we want to compare these different approaches across a range of criteria. It's not just about accuracy. It's not just about the number you get in the end. There are a lot more things to consider. To do this test, we needed a standard data set, something that we could disclose and that would be a common basis for comparison. So we used U.S. mortgage from Fannie Mae and Freddie Mac. And in fact, the data set is performance of 30-year term fixed rate mortgages. So under CECL, a 30-year term for a lifetime calculation is probably worst case. I don't know any other products that will have as high a result as this will. So when we talk about the comparison between the new rules and the old rules for loan loss accounting, you'll see some dramatic differences because a 30-year life of loan is a significant difference. This is a graph showing the data we have. Basically, we have about $2 trillion in assets to model and data going back to 2001. That amount of history allows us to see both the recession in 2001, the aftermath of that, and the aftermath of the 2009 recession. You'll also notice a spike in 2006, which is due to the bankruptcy law change. For loan level information, we have the usual types of measures: LTV, debt to income, product type, property type, location, etc. In the performance data, we have balances and delinquency and the usual things. So the goal here is not to do anything exotic when it comes to the factors that are being used for the modeling. All the models will use the same factors, the same segmentation, and the goal is just to see the differences that arise when you use different approaches. So the changes that we need to test under CECL, I already mentioned that we need to look at the full lifetime of an asset. Under the current rules, most people do a 24-month loan loss reserve for mortgage, basically the loss emergence period assumed to be 24 months. Under CECL, of course, it'll be lifetime. We look at credit risk attributes and segmentation, and in fact, for this study, we always use a segmentation on risk grade. So we have subprime, prime, and super prime. So every model you see is actually 3 models, one for each of those risk grades. And in addition, you'll see that we model by state within those risk grades as a test. We look at explicit economic sensitivities. We look at the difference between current environment and long-run environment and make comparisons. So for lifetime loss, the main point about lifetime loss is that it is the lifetime loss for the remaining life of the loan. In this visual, I have a loan that might be 14 months old. I need to know what the cumulative loss expectation is for the remaining life of that loan, not from when it originated. Now, there is an example within the CECL guidelines that suggests you could do full life of loan rather than trying to estimate the remaining life of loan loss expectation. But especially for a 30-year mortgage, if I have a mortgage that's been paying for 20 years and I only have 10 years left, the loss is very low compared to what it would have been in the beginning. I certainly don't want to be using a 30-year lifetime loss estimate when I've gotten to the 20th year. Even though it's allowed, we didn't even test that. For economic sensitivity, they specify that you need to distinguish between the foreseeable future and the unforeseeable future. And CECL is a, I don't want to say it's a derivative, but it is similar to the international accounting standards, IFRS 9. For IFRS 9, the adoption is ahead of where we are with CECL, and so for European banks in particular, they've mostly standardized on a 24-month foreseeable horizon. And I would imagine most U.S. banks will do something similar. But this is actually not specified in the guidelines. You're allowed to choose. The idea is that for the foreseeable future, you'll use a real economic scenario. And for the unforeseeable future, you'll use long-run averages. Now, the guidelines actually allow you to use 2 entirely different models. One model that should be high quality for the foreseeable future and another model that might just be a long-run average for the unforeseeable future. The problem with that approach is that long-run average default rates are usually historic averages, and they're averages of historic portfolios. And you can see in the U.S., in the 2009 mortgage crisis, just how bad an idea that was, because the credit quality in the portfolios varied dramatically. So for the unforeseeable future, if you want a long-run average, it needs to be a long-run average of the current portfolio, which is still a model. So we've chosen to have 1 model instead of 2 and simply use a mean reverting scenario for the economic component.
Hello, Joe. This is Pete, the moderator. Just wanted to note that the audience is wondering if you're advancing the slides.
Yes, I am. We may have a technology problem with that. Okay. I may have to come out of presentation mode each time I advance, unfortunately.
Okay.
All right. One of the options is to use discounted cash flows, and this is described as if it were a model, but discounted cash flows are really just a set of equations for aggregating. You need a model to use a discounted cash flow approach, so you would still need a model of expected losses, expected balance pay down, use those to project future cash flows, and then discount those cash flows. We'll also look at another discounting approach, which is simply that if we're making a monthly forecast of expected losses, we could use the time value of money concept on those losses to distinguish between a loss 20 years from now is not as big an issue as a loss 2 months from now. So using the effective interest rate, one could discount the losses and get to a discounted estimate. We'll show you that comparison. So for the models we test, we are looking at historic averages This is what most people are doing right now for their loan loss reserves, where they simply take an average of the loss rates and the payoff rates for the last 12 months and apply those going forward. I'll say right now, you will see how bad a result that is under a lifetime loss calculation. That's not a surprise. It's here only as a point of comparison. Time series models, roll rate models, vintage models, state transition models, and discrete time survival models. This is our set that we want to compare, all of which are tested either as a nationwide model, a single model, or as 50 individual state level models. For the historic average, I already mentioned, but we're looking at two specific rates, a default rate, which is going to be the balance that defaulted this month divided by the outstanding balance last month, and the balance that paid down this month divided by last month's balance. You can then use those as a very simplistic competing risk model to run through the life of the loan until you either hit zero balance or you hit 30 years for the full term of the loan. What we call a time series model is taking those same two rates, the default rate and the paydown rate, but using those time series, and in fact you didn't see, unfortunately. Let me go back to the slides it didn't show. The default rate here is the one that gets modeled then with a time series model, looking at how we could correlate this to economic factors in order to make predictions going forward. So we looked at the economic factors that are available from the Federal Reserve's economic scenarios, the DFAST scenarios that they publish. So GDP, disposable income, unemployment rate, house prices, mortgage interest rate. The Dow Jones is on here. It's not one I like a lot, but it's on here just to be tested for comparison. The transformation that's chosen is important, and here where it says log ratio, that's a better version of a percentage change. Log ratio is normally distributed and symmetric in its changes, so it's better for modeling, but it has that same goal of measuring changes. For unemployment, there's no clear answer on the right kind of transformation to use for unemployment. It might be moving average, it might be differences, it might be the percentage change. We tested them all. And in using these transformations, we also have to consider lagged effects. So if I'm looking at house prices, is it the house price this month, or is it house prices from 6 months ago or 12 months ago that's going to affect my defaults? And also the window, if I'm looking at a change in house prices, the window of that change, is it going to be a 12-month change, an 18-month change, a 24-month change? We don't know. So both of those are parameters that can be optimized. The next model we consider is a roll rate model. Roll rate models have been used for a very long time for retail portfolios, for mortgage portfolios, and by that I mean at least 30 years, if not longer. The concept is simply that you have accounts that are in many different stages of delinquency, and you look at the net roll forward. So basically you're taking the number of accounts this month in bucket 1 divided by the number of accounts last month that were current, and that becomes your net roll forward rate. You use that to simulate the transitions of accounts from one month to the next. Now this is an aggregate model. These are just time series of these roll rates. And so here are graphs of those roll rates. So again, this is really just a time series model. We're going to take each of these roll rates, correlate it to economic factors the same way we did for the time series model. We just have more rates that we're modeling now. Of course, you'll see that for the super prime segments, some of those rates can be quite noisy at times because we have fewer defaults. And when we go to small state segments, of course, that gets quite a bit noisier. The next kind of model we use are vintage models, and in earlier drafts of the CECL guidelines, there was specific mention of vintage modeling because the idea in a vintage model is that you consider the expected default probability as a function of how old how old the loan is. And for a lifetime loss calculation, that's very natural to look at. The graph that's shown here is the input data that you would have to work with. So for this mortgage data set, the first solid red line you see here is the 2000 vintage. These are loans that were booked in the year 2000, and this is a time series of their performance going forward. So now instead of time series by roll rate, we have a single probability of default, but we're looking at time series by vintage. Some vintages have high risk. You can see the dashed black line and the dashed yellow line up here are from the 2006, 2007 vintages. Let me make sure I'm showing that. The vintages that were originated in 2010, 11, 12, these have much lower default rate. The credit quality was much better. So with some experience, I can read graphs like this and get an idea of what's going on in my portfolio. The goal of a vintage model is to do that for you. So this analysis is based on the time series just shown. The graph in the upper left is showing the life cycle versus the age of the account. And in this case, the upper dark line is the line for subprime, and it's showing the monthly probability of default depending on the age of the loan, and you can see that it rises quickly and kind of hits a saturation. The lowest line on that graph is the green line for superprime, and that just rises slowly through the life of the loan. This increase in risk is largely a selection effect that the better accounts pay off early. If I look at the far right, I have a graph by vintage. So each point on this graph represents one vintage, and it's a scaling factor against that life cycle. Here the scale on the y-axis is change in log odds. So how much change in log odds do I get relative to my baseline life cycle expectation? You can see that some vintages are average. The 1999 vintage is right on the 0 point for all my risk bands, so that's an average vintage. The 2003 vintage is much lower in log odds, so it would scale down those life cycles. That was a very good vintage. But then through 2005, 6, 7, 8, you can see all of those rising dramatically. In fact, the change in credit quality, this is surprising for many people, I think, but the change is greatest for superprime. Even though the absolute dollar losses were highest for subprime, the percentage change, if you will, is highest for superprime. And then in 2009, it all collapses because only the best quality loans were being booked thereafter. The middle lower graph is an index capturing changes in the economic environment. And the data is thinner back in 2002 and 3, but you can see a recession in there. 2006 and 7 were the best periods in terms of default. 2010, a very bad period, and then improvement from there to the present time. So for modeling under CECL in a vintage model, we would take this environment function, take these 3 time series, and model them with economic data. We don't model the life cycle or the vintage with economic data, we just use them as given. And then the next model we have is a state transition model. And this is essentially a loan level version of the roll rate. So instead of just looking at what the net roll forward is, we look at every possible transition. If I have an account that is currently 1 month delinquent, what's the probability that it pays and goes back to current, that it makes a single payment and stays 1 month delinquent, that it makes no payments and goes 2 months delinquent, or maybe their last check bounced and they made no new payments, so they go forward to 3 months delinquent. So you get all possible transitions, including to default and payoff. So we need to model those transitions. And here we're showing in our data the probability of those transitions occurring. So in the rows I have the current state. In the columns I have the next month's state. And you can see that current tends to stay current. 1 month delinquent, the highest probability is to stay 1 month delinquent, but then there's also a probability of going forward to 2 or going back to current. And so the ones in green are the ones where we made specific models for the transitions. The ones in yellow, there wasn't enough data, so we simply held them as constant. The ones with the white background had almost nothing happening there, so we really couldn't do anything with that. But every one of these green background transitions was a completely independent model. Ideally, we would like to have done a multinomial regression model, but you have trouble modeling the low probability events because you need very large samples to do that. And even though we had some very large hardware, we couldn't get large enough samples to model all of those transitions in a single model. The last model that we are using is also very common. It's called a discrete time survival model, and this is a loan level version of the vintage model. Here we have a life cycle factor and an economic factor, but also scoring factors, and we even allow for vintage dummies. So we still have a vintage effect in here because of the possibility of adverse selection. What that means, and in fact we have an article that we have written that's available through the Philadelphia Federal Reserve on data similar to this, the U.S. mortgage crisis. The conclusion was that only about half of what was observed as credit risk in the mortgage crisis could be explained with the scoring factors that are available in a data set like this. The other half has to be called adverse selection. Something else was going on. The credit quality that came in was not typical for the FICO and LTV and so forth that was observed. So we allow for both effects in the model. So I want to pause, see if there are any questions before I go on. That's the list of models, and the next thing we'll do is show the results. Have any questions come through yet?
Not so far, Joe.
Okay.
But we'll monitor. If the questions are delayed, we'll pick them up here.
Okay, no worries. We can always come back to it at the end as well. So with any model comparison, the first question people will ask is, what's the accuracy of these models? Now, we don't have enough data to do a lifetime forecast for 30 years and compare models based on 30-year accuracy. That I don't know if that will ever happen in my career. What we've done here is to make 3-year comparisons. So this is cumulative forecasting error over a 3-year horizon. And you can see we picked 3 different starting points to get 3 different points in the economic cycle. January 2005 is right before the recession. July 2010 and January 2012 are different points in the recovery. And as you look through this, the first thing you see is that historic average, if you're looking back at the last 12 months to set your default probability and your payoff probability, and then try to predict the first 3 years of the recession, of course you're going to be terrible. So under-predicting by 70% is no surprise. This is really, as I understand it, the prime motivation for creating CECL. And of course, after the recession, you'll be dramatically over-reserved because it doesn't know that the economy is getting better. It has no economic factors. So the next 2, the time series models and the roll rate models, these are both similar types of models, just with different rates being modeled. The key thing is that we've used economic factors here to explain what's happening, but there's no explanation of changes in credit quality. So you can see the errors here are in the, say, 15 to 20% range. Credit quality is very dynamic. There's a very strong credit cycle that we've seen in some of the graphs so far. And that change in credit quality is not captured by the models. So that's the source of the high errors that we see there. And then the vintage model, the next one shown, this is still an aggregate model, but it's a model that allows us to measure both the credit cycle and the economic cycle. And that's why you get this dramatic improvement. Now, these are in-sample tests. And for the vintage model, it's hard to estimate the credit quality for recent vintages. So at the start of any forecast, you don't really know what the credit quality has been for the last 6 months. For that reason, as an in-sample test, these estimates are a bit optimistic. In fact, we believe the actual results you would get in a real out-of-sample test is going to be more in line with what you're seeing in the next two models, the state transition and the discrete time survival model. For both of those models, we're in kind of a 5% range on forecast error. Now, these are both loan level models. Everything above them are aggregate models. And so you get this interesting effect that, first of all, loan level models are not more accurate. They're more accurate than roll rate and time series models, but if you take the vintage model as a point of comparison, going to loan level does not improve accuracy. What it does is give you business value. The aggregate model, the vintage model, is great for giving you a number, but it doesn't tell you which accounts are the high-risk accounts. So the advantage to going to the loan level is business intelligence. It's not accuracy. Another thing to notice on here, and I'll go back to that first slide to make it more clear, is that when I say by geography, those are the rows where we made 50 independent models. In fact, we have 3 different segments. So those are the rows with 150 models instead of the row above, which is 3 national models. And you will notice there is no advantage in accuracy of having a separate model for every state. If you are in a local geography, of course, you want to model your local geography, but the advantage of modeling by geography is, again, business intelligence. If I have a portfolio, I'm based in Santa Fe, New Mexico. If I had a portfolio that's in Colorado, New Mexico, Arizona, and Utah, I'm unlikely to be more accurate by trying to make 4 separate models as compared to making 1. But I do want to know the difference between the economic environment in Colorado and New Mexico. New Mexico is a very oil-driven economy. Colorado is not. So those give me different business intelligence. Now, another aspect of accuracy is the error scaling by volume. And we'll make these slides available afterwards so that you can spend some time interpreting these graphs. But I'll give you the quick interpretation. On the x-axis, you have the log of the number of defaults. And so on the left, you have very few defaults. On the right, you have a lot of defaults. So it's basically small state versus large state. On the y-axis, you have the percentage error on a log scale. So this top number, 10 to the 0, that's 100% error. And so you can see the red line for the small states is random. It's 100% error. So the roll rate model on a small state is just a random model. Overall, the roll rate model is the worst performer in terms of scaling with error as compared to the others. The others kind of stack up as we would expect from what we saw before, but you'll notice the black line here is the surprising line. That's the time series model, and its accuracy is not good for the big states, but it's actually pretty good for the small states, and that's because when you have a sophisticated model with a lot of parameters and you get to a state with a few number of defaults, it's going to be difficult to estimate. Whereas that time series model only has a few parameters no matter how big the state is, and it can be robust. So the takeaway from this is that if you have a small portfolio, let's say you have a commercial real estate portfolio with a very low default rate, or pick your portfolio, but if you have a very low default rate or it's a small portfolio with a few number of defaults, you have justification for just using a time series model, even though for more data that wouldn't be the preferred approach. And so this is one of the first slides where we start getting to trade-offs, that it's not just about which is most accurate on the biggest data set we could find, it also depends on accuracy on your portfolio. And then there's the question of lifetime forecast values. So here we have the different models shown, and what's interesting is that the 3-year test I did and showed previously, that doesn't tell me what the accuracy will be for the lifetime forecast. That's only telling me the first 3 years. For the lifetime, these different models have different extrapolation properties. So even if they had the same accuracy on the first 3 years, they may differ quite a lot when I extrapolate for a full 30-year lifetime. And so if I make a graph of what's on there, it becomes very obvious. Just because of the internal extrapolation properties of the models, the state transition model has the highest lifetime loss forecast all the way along. And I have to admit, I don't have a theory for why this is. This is just an empirical result we found. And the time series model had the lowest lifetime loss forecast. The difference there is a factor of 2. And you can see the other models are in between. So you can make a choice based on accuracy, and yet the possible final result can vary by a factor of 2. It's quite striking. Also from that graph, we looked at the volatility. Now, I didn't even show the historic average on that previous graph because its forecasts were too high and too volatile. So if you're going through an economic cycle, that moving average, 12-month backward-looking average, is the most volatile way you can use to estimate lifetime losses. Ignoring that, the next most volatile models are the vintage model and the survival model. These are very accurate models. Now, accuracy means that you're following the economic cycle and the credit cycle very precisely. So accuracy necessarily implies that you're going to be more volatile in your estimates. And so if you are the CFO, try to choose a modeling approach, you may not like a modeling approach that's more volatile, even if it is more accurate. You can see that the time series and the roll rate models are not accurate, but less volatile because they're not including the credit cycle effects. So some people may prefer those for that reason. When it comes to complexity, this tends to track with number of coefficients. Time series models are very simple to create. Roll rate models are almost as simple to create. Vintage models take more work. They actually have fewer parameters than the roll rate model, but they are technically more challenging than the roll rate model, so there's a little variation there. But they're still manageable, and there are some standard algorithms for doing them. The state transition model has a lot of things to be estimated, a lot of parameters here, and in fact there are many ways to simplify state transition models. We did not test all the simplifications. We went for the most complex we could just to drive the greatest possible accuracy. You can trade off accuracy for simplicity in those models. The discrete time survival model does not have as many parameters as the state transition model, but again is technically more complex to create than some of the others. So it's one of the things to keep in mind. The regulators, the auditors know that the technical abilities will vary among teams. I don't know how much allowance they will make for that, but certainly we can point out the fact that some of these later models that are more accurate are also harder to create. And for the most part, computation time scales with parameters. You can see that here. This is the computational time required to run on the best server we could get at Amazon. You see on here the state transition models took a lot of time to compute. I should point out that this is a Markov model, meaning this is an optimized matrix multiply to do these forecasts, and still it takes a lot of time to run because there's a lot of data and a lot of transitions. We did not do a Monte Carlo approach, which would require even more time. sometimes you have to use Monte Carlo simulation for state transition models because you have factors with history, and our model didn't find that to be necessary, so we were able to optimize. Now, the next item to look at are discounted cash flows. And here I mentioned that there are different approaches we can use. Someone with a finance background will assume that a discounted cash flow model is where you predict the expected principal and interest payments going forward. Predict those monthly, use the effective interest rate of the loan in order to discount them back to get a net present value relative to the current outstanding balance. That is one approach. Now, the theory time value of money could be used directly on the losses rather than doing a payment calculation first. So the first thing we're showing, the option number one, is just directly discounting the loss estimates with the effective interest rate. The second one is where you do the discounted cash flow based on payments. And I will point out that if this was a credit card portfolio, you would need to include late fees and other types of fees, because that's a huge part of the revenue stream for line of credit products. So here we managed to avoid that just because they're less important, and standard practice in the mortgage industry is to ignore the late fees. But you might get a change in the result if you included them, at least a small change. In any case, the summary on here showing the original simple cumulative loss, that's what I've been showing on previous slides, just add up the next 30 years of forecasts. The next one is the discounted losses, item 1, and the third one is the discounted cash flow. And these ratios show that you get a reduction in loss reserves, basically 20 to 30%. For the direct loss discounting, it's right around, well, you can see it varies, but it's in that 20 to 30% range. For the discounted cash flow, it was kind of in a 15 to 20% range. To within noise of estimation, those might be comparable. So I'm not going to declare a winner here, but the real point is that discounted cash flows are considered to be an option. And so your option. If you want your losses to be 20 to 30% lower, then you can choose to include discounting. You may decide that for your portfolio management, you'd rather have the losses higher, and you don't have to do discounting, in which case you will get the higher estimates. The next slide here, this is a comparison between old rules and new rules. So the blue line at the bottom is what you would get if you were doing a 24-month loss reserve under the old rules, so a 24-month loss emergence period. The other lines, the green, the purple, and the red, are CECL calculations with and without discounting, these different ways of doing discounting. And what you see there, here is a summary graph, a summary table, that basically the comparison, this graph is showing at different points in the economic cycle what the ratio would be between the new CECL estimate and the old FAS 5 ALLL estimate. You'll notice that averaged through the economic cycle, the green box down here, 343% increase, basically a 4-time increase in your loss reserves. Or if you're using discounting, it's closer to a 3 times increase. This makes sense because we've got 30-year mortgages. The average life of the loan is about 5.5 years. So that's 5.5 years compared to 2 years under the old rules is going to give you an increase of 3 to 4 times. Now, when you make the transition, creates a huge amount of variation in that. Because if you're sitting looking forward into the recession, and in January 2007, we knew there's a recession coming. We don't know how big it's going to be. We certainly know it's not going to be continued improvement. Under the old rules, you would have that historic average carried forward for 24 months. Under the new rules, you would have to project a recession and then a recovery after that to a long-run average. And even the long-run average is higher than where you were sitting in 2007. So that is almost a 10 times increase in loss reserves if you adopt CECL, knowing that you're going into a recession. If you look at the other time periods, if you adopt CECL when you're recovering, where the economy is still continuing to improve, then these almost become in parity, especially with discounting. You actually in January 2012 would have them almost equal. Right now, they would diverge a bit again because the economic scenario is not for continued dramatic improvement from here, but more just a leveling out. So. The conclusions from all of this, we've put it into a handy little chart of pros and cons, looking at accuracy, looking at complexity, robustness, things like this. So it's a choice. You have to consider this portfolio by portfolio to decide how you want to model it, because the choices you make will have to be defended to auditors and examiners. So I will stop here for questions.
All right, folks, if you have any questions, please use the question function on the GoToWebinar. I do have some questions that have been submitted already here, and I'd like to start with those. The first one is, are there any implications for model selection during a period of increasing or decreasing rate environment?
Yes, the changes in the rate environment, they have some effect on defaults, but really they drive the payoff behavior. And if you get, let's say, if you're in a situation where you're getting more refinances, more early payoffs, and of course the risk is that they refinance to someone else. So that's shortening the life of the loan. So in a falling rate environment, you're effectively shortening the life of the loan, and therefore your loss estimates will go down. In a rising rate environment where you don't get much refi activity, then you're lengthening the life of loans and your loss estimates go up.
Okay. Would model selection affect the answer you get when you run portfolio optimization analysis?
It will if your typical portfolio optimization looks at the predicted level and volatility. Now, ideally, it should be a prediction of profit, and it should be volatility and profit. But some folks use optimization where they're looking at losses and volatility and losses, which is equivalent to economic capital, or some combination of these things. So since we have, what we saw when we looked at these models was both different lifetime loss estimates and different volatilities, you will get different portfolio optimization results depending on your choice.
Okay. Should a credit union run more than one model for operation or ALLL reasons? Do regulators have an opinion on the use of multiple models? How about auditors?
Okay. Because that question started with credit unions, I think it's not yet known. I can tell you for larger organizations who are required to do CCAR and DFAST, having benchmark models is considered standard practice, or at least best practice, where everybody needs to get to if they're not there yet. For credit unions, we all know most don't have a first model, so I think practically speaking, the next several years we'll be trying to get credit unions to adopt a first model. But if you look at the multi-agency guidance on model risk management, they do want comparisons, either third-party comparisons or internal benchmark models, some kind of a second model for comparison. So eventually I would expect that kind of guidance to filter down to credit unions.
Okay. Based on the FASB example 1 and the assurances made to small FIs, many may migrate to some kind of historic average. How would you be able to justify this based on accuracy, volatility, and a potential increase in the reserve? What would you recommend for very small FIs?
Well, I think if you're, let's distinguish by product type. If you're looking at a 30-year mortgage, a historic average just won't work. Honestly, the estimates are so inaccurate and so volatile that it'll kill you, to be blunt about it, because going into a recession, you'll have swings that are unbelievable. So if you have a long-lived asset, and I think even auto is a long enough life that you can't do a historic average, you're going to have to do at least a time series model where you correlate to economics so that you're not always looking as part of the economic cycle. Though it says you have flexibility, I'm not even sure a historic average would be allowed as you read the CECL guidelines. However, if you have a very short-lived asset, so it may be some kind of a 3-month consumer loan or a 6. In those, economic variability will hardly matter, and a simple moving average might get you by.
Okay. Can you explain the different views of discounted cash flows again, please?
Yes, and I have math. I can give you a paper with math, so we'll let everybody know that there is a 40-page document behind this presentation that's available after the presentation. But it's basically, if you start from the beginning and say discounted cash flow is really a time value of money concept, that a dollar tomorrow is more valuable to me than a dollar 10 years from now. And in the CECL guidelines, it says that the way to discount the dollar 10 years from now is to use the effective interest rate of the loan. Now, if we were trying to predict revenue, it's obvious that we would be looking at future payments. And really, that's where the discounted cash flow approach comes, doing loan pricing and predicting future payments so that they're getting future revenue discounted back in order to compute net present value. We're not trying to do pricing. We're trying to do losses. And so the first thing we predict is losses. So if you step back and say, well, if I want to know losses, why would I take a loss forecast, turn it into a payment forecast, discount that back in order to get a loss forecast? It's a lot of work. Instead, why not just take my losses and say a dollar lost 10 years from now is not as important to me as a dollar lost today? So you could use the time value of money concept directly on the loss forecast rather than on the expected payment forecast. Now, that's not the standard interpretation of discounted cash flows, but when you read the CECL guidelines, I can't see why it would be prohibited. So, and to ask that question, if I'm still not clear, try again. I'd be happy to try again.
Can you speak to the data needed for the different models?
That's a good question. I will start with all of these models except the historic average are trying to correlate to economic factors. And it's easy to tell from testing that you need one economic cycle in order to get a decent economic model. Now, if there are any statisticians on the call, you should know from old econometric modeling textbooks. In fact, I have photocopied. I went through to give a talk on this point and photocopied every economic data example from an econometric modeling textbook, and they never made a model with less than 50 years of economic history. They would always have 5 recessions, 8 recessions, things like that. We're modeling 1 recession. So let's be honest here. This is not statistically valid. But even to get directionally correct, 1 recession is the minimum. If you're down to 3 years of data or 1 year of data, you're not going to make any of these models off that data. what you're going to have to do is get external data, either from, as most of you know, we're doing a blind repository, a shared data pool with OnApproach in order to avoid that problem. Or you can go get time series data from FDIC or other sources so you can make some simple models. So that's the starting point. How are you going to get to at least one economic cycle? And then beyond that, I had a graph that showed number of coefficients, and you could say that the more coefficients you have, the more number of accounts you need. And in fact, that was the graph on scaling by number of defaults is probably the best way to answer that from this point. And so I'll leave that as take home from the document that you can download to read the full description.
I'll encourage any questions if you have. Dr. Breeden, what does a credit union need to document in terms of the vintage and discrete time survival model for auditors or examiners?
For those specific model types, well, it's an interesting question. I'm not sure that the documentation is model specific. I've done a lot of documentation for CCAR and DFAST, and I know that for credit unions that won't be the starting point for the standards, but the guidelines on documentation are the same. So let's just say they want you to start with a discussion of your data. So for any of these models, I showed some graphs. What are the time series for the roll rates? What are the vintage time series? You need to be able to visualize your data. You need to be able to explain why you made the choice you did. Maybe you're going to reference a study like this in order to say, for this size portfolio, we made that choice, something. But you need some justification for your choices. And then you're going to need to, of course, document the details of the estimation approach. What's the math behind it? Now, this could be daunting for a lot of organizations, and in this case, you may be calling on a vendor to build you a model. That vendor had better disclose the math too. I know some vendors want to have secret sauce, and there is exceptions are allowed for the FICO score. FICO doesn't have to divulge their equations. Moody's and S&P don't have to divulge their coefficients behind their risk ratings. But if you're building a model off those things, you will have to disclose all the math. So complete disclosure of the estimation process and the coefficients, and then you will have to validate. And it's not possible to do a true out-of-sample validation in the sense of what you'd like to do is build on one recession test on another. You won't have that much data. But you at least need to do some basic in-sample tests, some out-of-sample tests, what happens on a one-year out-of-sample test, just to show no discontinuities, no odd behaviors, those sorts of things. So documentation is critical, and you have to assume that you'll spend as much time validating and documenting as you did building the model.
Okay. In an earlier question before this one, you mentioned needing one cycle, but CECL requirements say minimum data should be at least 3 years.
Yeah,
comment on that?
I will. I'm speaking as a modeler. I'm actually a physicist. I won't call myself a statistician, but just as a modeler in general, practical experience is your model will be very poor quality if you have less than one economic cycle. CECL may say 3 years. That's fine. And in fact, I would often tell people I need a few years of data, but when I say that, I'm assuming that I'm going to augment it with some FDIC time series or a pooled data repository or something. So what they say as the minimum data set, let's just say that all the model types they listed, you can't build a decent model with the amount of data that they said they require.
Well, speaking of that external data option, in terms of that data and economic correlation, have you discussed with regulators and auditors what their stance would be on external data like that? That is national or regional loss information?
It depends on the size of the organization. I think, again, CCAR and DFAST are the best examples to use. If you were a CCAR bank building forecasting and stress testing models, and by the way, they're going to try to use all those CCAR models as CECL models, so this is a fair point of comparison. The examiners are very unhappy if you use external data to build a model for a top 10 lender in the U.S. If you're a top 50 lender, DFAST, that next tier down, they allow external data to be used, but you have to prove the similarities. You have to show that it's comparable to your own portfolio. When you go down again to smaller portfolios, and especially if there's a credit union that has less than 200 million in assets, you will find it difficult to make any of these models on any of your portfolios. I think some kind of shared pool or external data augmentation is a requirement for a good model. Now, they may let you do some average or something. I'm not saying they won't, but if you want a good model, you will need external data. And so there is precedent for using external data. There's a more or less established process for showing how you're using that external data. And I expect more leniency for credit unions using external data because of these needs. So I would think it will be a part of what NCUA looks at, but of course we don't know yet.
Okay, well that looks like we've come to the end of our time. I appreciate your insights, Dr. Breeden. Thank you very much. I hope everyone enjoyed today's session. A follow-up email will be sent to all attendees to field any additional questions and then have links to pertinent information. I'd also like to thank my colleague Mark Ports for handling the behind-the-scenes work for the webinar. So again, thank you for participating in today's webinar. Have a good day.
Thank you, everyone.